Ethereum on-chain data suggests that the price of ETH may fall further. Analyzing Ether's ETH current worth chart paints a bearish picture, which is largely justified by the 11% drop over the previous month, but different traditional finance property experienced more severe price corrections during the same time period. The Invesco China Know-how ETF, CQQ, is down 31%, while the Russell 2000 is down 8%. At the moment, traders are concerned that losing the descending channel support at $2,850 will result in a more severe price decline, but this is largely dependent on how derivatives traders are positioned in addition to the Ethereum community's on-chain metrics. According to Defi Lama, the Ethereum community's total worth locked, TVL, has flattened in the last 30 days at 27 million Ether. TVL measures the amount of money deposited on smart contracts, which include decentralized finance, DeFi, non-fungible token, NFT, markets, gaming, and high-risk functions. The Ethereum community's average transaction fee increased to $13 after hitting a low of $11.50 on April 20, but it's unclear whether this reflects a decrease in the use of decentralized applications, dApps, or simply customers taking advantage of Layer 2 scaling options. The premium on Ether futures is skewed towards bears. Merchants use Ether futures market data to understand how skilled merchants are positioned. However, in contrast to the standard perpetual futures, quarterly contracts are whales and market makers' preferred instruments because they avoid fluctuating funding charges. The difference between longer-term futures contracts and current spot market ranges is measured by the idea indicator. In fair markets, the annualized premium on Ether futures should range between 5% and 12% to compensate merchants for locking in the cash until the contract expires. The current 2% Ether futures foundation clearly demonstrates a lack of demand for leverage patrons. Though not exactly a backwardation, detrimental premium, an annualized futures premium of less than 5% is frequently regarded as bearish. This data indicates that professional merchants have been neutral to bearish in the previous couple of months. However, to rule out externalities that may have influenced derivatives data, one should examine the Ethereum community on-chain data. Monitoring community use, for example, tells us whether or not specific use cases help the demand for Ether. On-chain metrics are slow. Measuring the number of active addresses on the network provides a quick and reliable indicator of efficient use. In fact, the increasing adoption of Layer 2 options may lead to this metric being misguided, but it serves as a starting point. The current average of 584,477 daily active addresses is 4% lower than 30 days ago and nowhere near the 675,117 seen in November 2021. As a result, data shows that Ether token transactions rarely show indicators of progress, at least on the first layer. Merchants should rely on dApp usage indicators, but avoid a singular focus on the TVL because that metric is heavily focused on DeFi functions. Counting the number of lively addresses provides a broader perspective. Over the last 30 days, the number of active Ethereum dApps addresses has decreased. Overall, the data is only marginally disappointing, given that competing chains such as Solana, SOL, saw a 34% increase in active addresses. The $2,850 descending assist channel resistance will not hold until there is first-rate progress in Ether transactions and dApp utilization, triggering a deeper short-term worth correction.